Hello everyone, today is January 14th and this is our session number 2 of the Wyckoff trading course. We had a really good session, first session, it was a lecture session. Today, just because we haven't covered a lot of the material last time, or at least as much as I planned to cover, we're just gonna probably be still in the lecture mode today, but starting from the next session where we will discuss the homework on accumulation, specifically Home Depot, that would be the case study for us for homework. Then I will start pulling out people and we'll start conversing and we'll start talking and we'll start analyzing. So we'll get to this point. Don't worry about this, guys. The main thing to remember is that once you have the homework, what I really would like you to do, and this is going to be extremely important to us, is to submit your homework in a specific way. One file, either PowerPoint, PDF, or Word doc, and then put your first name with the last name initial in the name of the file. Email it to me, to my personal email. I've sent out instructions for the homework, and I've mentioned that my personal email, simplecot@hotmail.com, is the one that you should use. I will remind you again. I will email you again. I will also email you tonight the home page for our class. So this page usually will contain the videos and the slides. So I will email you the link to this page because it's unlinked, so you cannot see this page on our website. And then I will email you the password to that page. It's password protected. And I would like to ask everybody to be confidential about the access information. It's only for your use. Okay. Let's talk about what we're going to cover today and what's coming. So session number 2, we're still on the price structural analysis. We're going to talk today about the change of character. This is a very simple concept, very elegant, and very powerful. So we will explore the reasons of why we need to understand the change of character, what it leads to, and what kind of assumptions, deductions we could make out of that on the analytical front. And then once we will understand that shift that change of character provides from one environment to another, we're gonna reside for a while in the environment, in the non-trending environment with the bias to the upside. So both accumulation and reaccumulation will be discussed. There we will be discussing Wyckoff events, Wyckoff phases, and we'll talk about the phase analysis a little bit today. On the reaccumulation, we will have a conversation about conventional and alternative labeling. So we'll revisit that, and that will be extremely helpful for your homework. So guys, please pay attention, especially those of you who are going to do the homework. And then, time permitting, we're going to start covering price structural analysis points that are going to be related to both accumulation and distribution. But there are certain things, certain events, certain phases, certain shortcuts that I'm going to give you, and we'll talk about different characteristics for different Wyckoff events. So in this conversation starts today. For your homework, this is the one that we haven't done for this class. So this is going to be an accumulation labeling. And as I mentioned, it's going to be of the Home Depot. All right, and then in the next class, which is going to be January 21st, we're still covering price structural analysis. We will review our homework. So there will be a lot of questions. Every cycle, there are so many questions the students send in their emails with their homework. This is fine, you can do this. Just don't expect me to answer those emails, via emails, because I just don't have so much time to answer each email that comes to me. But my promise to you is that I will look through all of your homeworks. That's number one. Secondly, I will identify what is the common theme for mistakes that we are as a group conducting. And therefore, those are going to be the primary questions that we're going to answer in our homework review. Also, with the homework review, this is the chance for us to establish that communication where I open up the microphone and somebody steps in, a volunteer, and then we go through the chart first, and we go through the logic of labeling, how we're labeling the chart, what's going to be the first thing to label, what's going to be the next thing to label, and so on and so forth. So please be prepared for this type of the conversation, for the discussion of the homework in the next class. Then we're going to continue exploring all of the price structural analysis points, distinctions, something that, you know, we either gonna cover more, or we're gonna cover in general. There's gonna be some distributional things that I'm gonna add to this as well. And next session also will be devoted to a distribution. So we'll talk about Wyckoff events there, Wyckoff phases, the psychology of the distribution, and so on and so forth. And the homework is going to be obviously on a distribution. So you will have, 6, 7, 8 charts that you will have to label. And then we will review this homework in session number 4. So that's the plan for today and for the next session. As you could see, it always changes. It depends on how much time we have each session, how much material we cover. Sometimes we slow down because something is very important and we need to understand those concepts. Sometimes we actually, speed up. So we'll see how it's going to go. It's always kind of like a living, breathing organism. Okay, so the first concept that we'll talk about today is going to be a change of character. And that concept is going to be discussed for both accumulation and the distribution. So let's talk about the theoretical portion and the theoretical concept of the change of character. And we're going to start with a very simplistic explanation as to what are we actually looking for in the markets as we look at the price structure. And we definitely realize that there are 2 types of environments that we're expecting. First environment is a non-trending environment. This is the environment of a consolidation. We also will call this environment a trading range. We also will intermittently call this a non-trending environment. So all of this semantics regarding the trading range or consolidation are valid for us. So when you're going to say something like, okay, I'm looking at the trading range, I'm looking at the consolidation, I'm looking at the non-trending environment, I know instantly that we're discussing a trading range which is confined between the levels of support and the resistance, and predominantly which is going to have some kind of horizontal range where the price deviates around the mean horizontally. We'll discuss later on some other trading ranges which are going to be upsloping and downsloping. So, and we'll give the definition and also I'll give you the rules as to how to construct those. But for now, we are either discussing a non-trending environment or a trending environment. A trending environment is going to have 2 types for us, an uptrend and a downtrend. So that's how simple I want you to think at this level. And these are kind of like the basics. These are very simplistic stuff, but at the same time, I want everybody to be on the same page. So the biggest question that we have about these 2 environments, obviously, is for the non-trending environment, we want to understand the bias. We want to understand the timing of when the price comes out of that environment and starts to trend. We also want to understand the character with which the price will travel out of this consolidation. So those are the goals for us to explore analytically in the non-trending environment. And then in the trending environment, obviously, we would be assuming that we're already in the position. And if we're not, then we would be looking for another trading range, which is going to be a reaccumulation range in the uptrend. And this is where we would be looking for to establish the position. And we want to understand the character. So character is extremely important. And then the last thing about the trending environment is we want to understand where the stopping action occurs, reversal, and a switch into a non-trending environment. So those are kind of like the priorities for us with trending and non-trending environments. Having said this, when we are in the main thing between these two environments is that switch that I already mentioned. So we want to see, let's say, a non-trending environment. Then we want to identify some kind of switch which would lead us to a trending environment. We want to do this in reverse as well. From a trending environment, we want to identify the switch that will give us an understanding that we are going into now non-trending environment. So what is this switch? How would it look, and how would we see it? Well, first of all, the name for this switch is going to be a change of character. And the change of character, if you think about the name, a change of character. So it seems that one environment had a specific character and then it changed. So what has changed? What would give us an indication that a change of character has happened? So obviously a change by itself, as the word assumes kind of like a meaning of something is going to be happening in a different way than the way how it happened before. So when we talk about, let's say, one environment, which in this case on the schematic is a downward trend, and we would be thinking what kind of character of a trend it would be. So obviously the legs to the downside are going to be much more pronounced than, let's say, the legs to the upside, where we're going to have attempts to reverse and to actually cover the ground that we lost in the downtrend. And obviously those rallies are going to be smaller. They're going to be populated with some pockets of increased supply. This is where more selling is going to occur, and then additional selling is going to come. So it will not allow the price to go up significantly. And that's going to be, the main price characteristic. The main volume characteristic of the downtrend is going to be all about the increase of the supply on the reactions, and then diminishing volume signature or diminishing demand signature going into a rallying mode. And then every time we're going to have some kind of consolidation in the downtrend, we're going to structurally jeopardize the support area, and we're going to break to the downside. So that's going to be a repeated behavior until we actually exhibit a stopping action, which is going to be labeled by us as a sell-in climax. So then this is what we're going to have in the downtrend. And this behavior is not going to change until a certain point. So what is that point? That's the biggest question that we want to address. And that point is going to be a change of character. And think of this in reverse. I've just shown you how a downtrend would behave. Then think about that change of character. So if in the downtrend we had the price going down more than up, then obviously in the change of character environment, we want to have the rally that's going to start outperforming. That's number one. And probably on this rally, we want to see the increase of the demand. We want to see the presence, of buying. And usually that presence, because it's so early in the trading range, it's so early in the accumulation process, it's mostly going to be associated with the contrarian buying by huge institutions. We'll talk about this a little bit later on. Let's come back here to the change of character. So the rally should change. The behavior of the rally should change. And we're going to say that the distance of the rally should increase relative to the distance of rallies that we've experienced before on the way down. The upspread should increase. That's what's going to kind of propel our view on how buying is unfolding. That's what's going to increase the distance. That's what's going to increase also the velocity and the momentum behind buying. And we obviously want to see the change in the volume behavior. So we want to see the demand increase. We want to see volume increase in general, because it would signify to us that it's not only selling by weekends that we're experiencing on the way down into the climactic action, but also there is some buying behind this. And also on the automatic rally, that first change of character, first change of behavior, we want to see the volume increase. We want to see the demand increase as well. So it's in this area after the stopping action that we are going to see the best rally that we have seen in the downtrend. And right away, when we think about this rally and we think about that this is a possible change of character, we always thinking that the change of character will lead to the change of the environment. So we were in the downtrend environment. So now we would change that to some kind of consolidation. So we know that the trading range is going to unfold. We still don't know the bias at this point. And this is a little bit more of the advanced studies that we do in the practicum. There are certain things, certain ways of how you could identify possibly the potential bias of the consolidation in phase A. I will give you some of the shortcuts as to how to logically think about the bias even in phase A and as we go through phase B and specifically in phase C and D. But at the beginning, usually we're going to be questioning as to what kind of bias we have. We also will not know a specificity like a duration of the trading range that's going to unfold. Again, in the practicum, just because it's more for the advanced studies, we will create kind of like an understanding as to how we would measure a potential duration in the consolidation. So I think it's extremely important as well. And obviously, it's important to also understand the character with which the consolidation could unfold. Is this going to be a long-term range or a short-term range? How is supply and demand are going to behave? What is the behavior of institutions and weak hands around the edges of the trading range at the support and the resistance and so on and so forth? So quite a few things to address. But the main thing with this new rally, with the better rally, is that the change of character is possibly unfolding. And that would mean that from a downtrending environment, we are going to change into non-trending environment where we have to define the bias, where we have to understand the duration and the timing with which when the price is going to leave the trading range, and then the character of the trading range itself. The confirmation of this change of character is going to come on the next attempt to push the price lower. And this attempt will fail, and it will create a test, what we will call a secondary test. I often call this a local test to the local event, which is the climactic action. We will discuss the selling climax later on today, but for now, just keep in mind that this final test of the change of character, this is an attempt to continue a downtrend, which will always fail. And even if we have different secondary tests, we could have a secondary test that is going to be like shown here on the schematic, a high low. We could also have a test that is going to be a low low. And we also could have the test, which is basically going to be at the same level as the selling climax. So in all three cases, this is a successful test. Even though the lower low is being created, the lower low is just basically tells us that there is still some supply available, or demand is still relatively poor, and that's what brings the price below the support. But they all three are going to be successful tests. Why? Well, because they recover after the test, they reverse, and they come back to the area of the resistance, therefore finishing the downward swing and reversing that swing. So again, something, for the future for us to remember. So let's come back again to the change of character, as we're experiencing our first change of character in the consolidation, and there are, by the way, two of those. One is on the way into the trading range, and one is on the way out of the trading range. Change of character, you could also say the first one is in phase A. So what is happening here as well? Well, we said that the price is going to look different, the volume signature is going to look different, and then it's going to be confirmed on the secondary test. Well, why is all of this happening? Let's quickly kind of talk about this. Well, the first assumption that we have of why the change of character is happening is that the behavior of market participants has changed. So if we talk about strong hands, and we obviously would be thinking about hands like composite operator, huge institutional trend followers, big money contrarian type of traders. What are they seeing here around the climactic action? Well, what they see in a panic by weekends, which basically leads to, on the very technical physical level, increase in volume signature, and therefore a very substantial increase in liquidity. And by liquidity, I mean the availability of shares in big quantities. We always think about the CO as being limited by certain rules, by certain regulations even. What are those? Well, because of their big size, they want to open big positions. How do you open a big position in a stock that might be maybe like illiquid, right? So they would never go to this type of the stock. They need to be in the stock that is liquid, number one, and they need to invest at the spots in the price structure that is liquid. Imagine a big institution is trying to establish a position on a sign of strength or on the breakout or in the uptrend. What would that produce? That would produce such a big jump in price because of their size. So they need to cover their steps and open the position when they can, when liquidity is available to them, when shares are available to them and readily available. So a panic by weekends where either public or professional hands that are on the wrong side of the trade, institutions that are on the wrong side of the trade, they're having a panic, and meaning that they're capitulating and they're getting rid of their holdings quickly without any doubt that there could be a stop in action soon, and they're willing to do this at any cost. So that's what produces that increased volume signature, acceleration of the price to the downside, and that's what creates that liquidity that is needed by institutions. The next thing that they really need at this point is some kind of value proposition. They need this stock to be at the price that has a long-term value for them, because still thinking about the whole process of absorption of the supply that is available in phase A, they might be thinking that it's going to take some time for the price to stabilize and then for the price to start actually going up. So they have an understanding of the time horizon that they will need, and their biggest, one of the biggest two requirements to get into this position is also going to be the value. Is it worth it to me at this point of time with this price to get into this position substantially, or at least start scaling in into the position? If the price is attractive, if the stock, in their opinion, is undervalued, they're going to come in and establish this position, at least incrementally. And because of their size, what's happening is whatever increase of the supply that was produced by the weak hands on the capitulation is going to start gradually be observed. And we could observe some of the situations where big institutions, CO type, contrarian institutions are already in the buying mode, they are accumulating, and yet some other institutions and the public, the weak hands, are still selling. And that's the exchange of shares that happens around the climactic action, and specifically selling climax. Panic buying by weak hands produces a lot of volume signature, a lot of liquidity, takes the price down to the point to the zone of value, and that creates those two conditions where big institutions that are contrarian are coming in and they're buying those shares. As they buy, the supply that is presented by weak hands is being absorbed by strong hands, and that stops the price first from moving further down in a very accelerated way. That's number one. Secondly, it stops the price then from moving further down. And thirdly, once absorption has happened at that local level, then the price could actually go up and create an automatic rally or a change of character rally. So, and that's the whole process around the selling climax. And that's the whole idea behind the change of character. So with change of character, again, is a change of behavior. And it's a change of behavior for both weak hands and strong hands. And visually, we could identify that change of behavior, which would suggest to us a change in environment. And from a trending environment, we're going to go into the non-trending environment. Okay, let's talk about the second change of character. That second change, as I mentioned, is going to be on the way out. It doesn't really matter whether it's an accumulation or a distribution. It's still going to be on the way out before the markup happens and the markdown happens. Actually, if we would be more precise, we could say that this change of character is going to be a part of the emergent trend. And by the way, I've talked about this in the last class. It's an extremely important concept for us from the point of view of timing. This is where all of our trades are going to originate. And this is where I'm going to lead you guys to both in the selection process and also in trade management. In our selection process, we just want to find this moment. We want to find the moment where accumulation has been either concluded or in the last stages of conclusion, and therefore we could say in the last stages of absorption of the supply, whatever supply is available at that point of time. And the price and the volume starts to show a different behavior. What is that behavior by the price and volume? Well, the first thing that we will notice is that, again, on the price side, we want to see the difference between how the rally, the most current rally, has been unfolding relative to the behavior that was exhibited, of the same behavior that was exhibited in the trading range before. And here we would be comparing, again, the distance that the rally is increasing. This spread, the up spread, that is increasing as well and has a different type of look. We also will be talking about some gap activities there on the sign of strength. And then we also want to see from, let's say, the price behavior, the reactions on that sign of strength, how they're going to behave. Are they going to exhibit increase in supply? And if they do, would that supply be absorbed? If it's going to be absorbed, then how quickly it's going to be absorbed? We also would like to see the volume change as well. So rally and the volume. So here in the volume signature, one of the things that we're going to pay a lot of attention is increase of the demand or the consistency of demand. And that would identify for us the buying by institutions. That's number one. Secondly, we want also to see what kind of urgency of the demand is there. That's another question, and that's going to address the character of the next rally and of the next trend, actually. So, and we'll study this more, in the second portion of the course on the supply and demand. So we'll talk about this. But coming back to the change of character, the concept is going to be the same as the concept of the change of character in phase A. We want to see the rally that is going to be better than what preceded it. So in the case of the phase A change of character, where we had the downtrend, we want to see the rally that was a better rally in the downtrend. And then we want a secondary test to confirm that there is no further continuation of the downtrend. In the change of character in phases C and D, we want, again, the same thing. We want to look at the rally and we want to say that this is the better rally of them all in the non-trending environment that we are currently in. And then as a confirmation, we want to look at the backing up action, and we're going to say that for the first time, this is the reaction that is so different than what we've seen before in the trading range. On this schematic, it looks even different. It's more horizontal than vertical, right? Than the reaction that goes down to the support. It still goes down to the support, but it goes down to the support now that has acted before as the resistance, and that's also a big difference. It's also a change of behavior, and that concludes a change of character. We also would like to see that the supply signature is going to be diminishing. And there are quite a few variations on the supply, how it occurs in phases D. This is again something of a more advanced studies, for the practicum and for the second portion of the course. But generally, we would like to see that supply and the backing up action or last point of support is going to have those, contracting elements, or if supply comes, the absorption happens much faster and much easier. So we'll talk about that. All right, so these are the two changes of character. Again, change of character in phase A, that's going to be on the way into the trading range. Change of character in phases C and D is going to be on the way out. And it doesn't really matter whether it's accumulation, reaccumulation, distribution, or redistribution. It's going to unfold the same way. It's going to have some variations. You might have a variation where, let's say, a buying climax happens, and then you have, very frustrating increased, diagonal formation, where the change of character might come slightly later on, and we usually talk about this in the practicum. This is a little bit more advanced, and then have a trading range. So, something like this obviously is just a variation on the theme. But once you identify a change of character, then you know what's going to happen next. Most likely that's going to happen as a trading range. The same with the distribution. We're looking for the climactic stopping action, and then we're looking for the first reaction that's going to be so different than any of the reactions that we've seen before on the way up since the last meaningful consolidation. And then after that, as it suggests a consolidation, then we will be thinking about, okay, well, in this consolidation, what is the bias? and then what is the timing as to when the price is going to leave the trading range, and then what is the character, and so on and so forth. Change of character in the distribution on the way out is going to have the same characteristics as an accumulation, only reversed. We're going to have the reaction that is going to be the best reaction in the current environment, which is a non-trending environment. And then after that, it's going to be confirmed by an attempt to rally that is going to be the worst than what we've seen in this distribution formation. And therefore, we are confirming a change of behavior and a change of character before the actual move to the downside. One last thought here on this slide. Please note that structurally, we always talk about Wyckoff layers, right? So when we talk about, let's say, specific volume signature should be this and such, in a specific phase. So I want you to think about the change of character and think about Wyckoff phases and Wyckoff events and where a change of character usually would occur. So on the way in, whether it's accumulation or distribution, that's all going to be in phase A. And you're always going to be looking at the automatic respond or automatic rally in the accumulation and automatic reaction in the distribution as those first two counter to the trend events that going to lead you to the conclusion that this is a change of character and therefore we are going to start a non-trending environment. And then secondly, in phase A is going to be confirmed by a secondary test. So that's on the way in. On the way out, I want you to remember that the events, Wyckoff events that we're going to discuss is the lowest point of the trend in phase C for accumulation, the highest point of the trend in the distribution, and then a sign of strength, a major sign of strength, and a major sign of weakness, which are going to be followed by the small counter move to that. So you're going to be predominantly in phase C and D, and you're going to be covering the major sign of strength and the major sign of weakness as your first change of character lag. All right, any questions, any comments on this? And by the way, at any point of time, guys, if you feel that you have questions, just type it in or just say, I have a question, and I will come back to you and I can unmute you. But if there are no questions, I'm going to assume that everything is fine here. So let's go to the next slide. And let's look at the examples of a change of character and how it unfolds. And I'm going to show you here. Oh, okay, great. We have some questions. So let's just address some questions first. Okay, let's go to Eric. Hey, Eric. Eric AE. Okay, so what's the question? Okay, Eric, I'm trying to unmute you. So you have to unmute yourself. Okay, check.
Hello, Roman.
Yes, hi. How you doing?
Hi. My big question is in the phase A or in the change of character. The secondary test, you say that can go below of the selling climax.
Okay, so I gave you 3 scenarios for the secondary test. We're discussing this spot right here. So still phase A. The secondary test acts as a local test of the climactic action. It basically tells us the story of the supply. Is there still a lot of supply left, or a story of the demand? What kind of demand we have there? And again, 3 types of secondary tests that we could have, right? So a test that goes and creates a low low, a test that goes and creates a high low, and then a test that is basically on the same level. So what's the question?
Well, the question is when the secondary tests go below the silent climax. So how to identify in the volume that the price will go up again to the trading range?
Mhm.
Well, it's like the dove that I have.
Okay, I got it. I think I understand the question. Okay, so the question is, how do we know? Let's say if it goes to the lower low, how do we know that this is a legitimate secondary test? So that's the question. Well,
Thank you.
sure. Okay, I'm gonna. Okay, so you muted. Okay, great. So the first thing, there are a couple of things here that I want you to think, and we are definitely kind of like jumping a little bit ahead, but that's fine. I like the, the inquisition of the mind even at this point, so that excites me. Um, there are two things that we should consider here. The first one is if we correctly identified a selling climax, which is going to be a stop in action to a downtrend, and then we correctly identify the characteristics of the automatic reaction, or rally rather, in the accumulation. Then our assumption that the secondary test is going to come and it's going to be confirmed are probably very high. And even if it's going to create a lower low, that's totally fine. We just don't want this lower low to be significantly lower, right? So we don't want the price to fall, another like 50% and then say this is an secondary test. No, that's not going to be the case for us. It has to be relatively close to the support. So the action by which we identify a potential stop in action and automatic rally should lead you to the conclusion that even a lower low could be a secondary test. The second point here is all about supply and demand and the price reversal around the area of the support. So we will be observing specific price reversal patterns that are being confirmed with the volume signature. So for instance, a reversal of the last significant bar, we will talk about this more in April, March, and then increase in demand signature. That would suggest that demand is actually coming in, and it not only absorbs the supply, it actually pushes the price back above the support level. And that's when we're going to say that now we see a confirmation of the reversal, therefore we're going to have a rally up, therefore secondary test is confirmed. So we'll talk about this process, but a good question. All right, let's see some other comments here. A question from Rami. Automatic AR, is this an automatic rally? Excuse me. Depending on the context. Okay, so there are three ways of how I'm going to address automatic rally or automatic reaction. I'm going to say in general terms, automatic response. So it's the same, the same letters, AR, but obviously we want to say automatic rally for accumulation and reaccumulation. And we want to say automatic reaction for distribution and redistribution. And then obviously in the reaccumulation and redistribution, we're going to change that, and I'll talk about that. But for now, I just want you to remember that AR, this rally right here, is basically an automatic response. Automatic response to what? It's an automatic response to the change of behavior that we have around the selling climax. So in a way, it's an automatic response to the selling climax itself, what is happening at this point. We also sometimes mean that automatic, meaning that it's almost like a technical rally, right? So what would constitute a technical rally for us? A technical rally is something that happens just because there is a close of positions in the direction of the previous buys. So we had a downtrend, and a lot of professional traders were short in this market. And then once they see that the conditions are changing at the bottom of the selling climax, what do? They close their positions. So therefore, their short positions are being converted into the market position, which is a buy order. And therefore, they are not betting necessarily and gain the profits from the market potentially reversing and going up short term on the automatic rally. But what they're betting on is that this is going to be the low and I need to get out of this position because this trade is done. So in a way, their behavior is an automatic way of pushing the price up. So sometimes I think about automatic response as that, automatic covering of the short position by those who have profited on the way down. So that's why it becomes an automatic response. Okay. Should we wait for stopping action or selling climax before we get out of the existing position long and short? From Nilesh. Okay, I'm sorry if I mispronounced your name, and I'm glad that you joined us for this session, so that's great. So we will address this a little bit later on. Then the next question from Joe. Is there any big news usually associated with what, Joe? With the selling climax? With the secondary test? We'll talk about this as well. Okay. Okay, was the selling climax. Okay, well, as long as we're here, let's just, address this, and then we will come back to this slide. Yes, selling climax is going to be associated with a big event, and that big event usually is going to be the price action itself. So for those of you who watch, let's say, CNBC, right? I usually don't watch it that much at all. Only watch it at the points of interest. CNBC or any other TV shows could act as a contrarian tool, could act as a sentiment tool, and usually when, let's say, a stock is exhibiting some kind of panic where the price is going down so quickly and there is a lot of selling by weak strong hands, how do you think that's going to be it's going to be portrayed on the TV? So usually they're going to say Apple has a gap down like it has recently has had, and overnight action is going to show us the gap to the downside at the open. The volume is very high, and it's going to be in the news, especially a stock like Apple. I mean, obviously a small stock, not an interesting stock, nobody would even care, but something like Apple will have a spot on the TV show as a concern. So that would be a big event for the stock itself. Having said this, what obviously Joe meant is the event something like earnings, right? Or the reaction to earnings, a change in management, some kind of, big numbers that are coming out on the revenue, on the sales, and so on and so forth. So those could all be big events, and they could produce a lot of volatility up and down, a lot of liquidity, and so on and so forth. So yes, selling climax could be potentially one of those spots. And when we say big events, we usually think big volume, big liquidity. So, and selling climax is exactly that type of the event. Big volume, big point of liquidity, a lot of value. So could be both. Event as a price event by itself, and then some kind of catalyst event that are going to produce that price action. Yeah, really good questions today. I really like that. Okay, from Amel, are there a limit to the number of secondary tests in the trading range before the sprint? How do we identify a sprint versus a secondary test? Yes, okay, again, so inquisition by your minds at this point, bringing us a little bit faster to, where we should be. So I welcome all of these questions, but at this point, let's just kind of like note them, and we will answer as we go, as we uncover this stuff. Let's come back to the change of character. Let's look at some of the examples. So this is Yahoo. You guys don't see this, but this is Yahoo, and this is what, 2012, 2013, 14. And Yahoo actually was such a great trade out of 2012. There was a management change that came aboard, I believe in 2012. There was quite a big trading range that came out of the oversold condition. Then we went into the accumulation range, and out of that, we're looking at the latest phase C right here. It's out of that that we have the first leg to the upside. And this acts as a sign of strength in the backing up action. So by itself, it looks as a change of character relative to the environment that we've been in before. Do you guys already see where is the high probability point of entry for us? It's not necessarily in the area of the emergent trend. It's actually in the area where a trend has been confirmed. So where do you think the trend has been confirmed? Write it down really quick. Where do you think the trend has been confirmed for Yahoo? Give me the timestamp, like a month and a year. What is the highest probability spot for us to participate in this move to the upside? Okay, backing up and last point of support. So somewhere here, December, January of 2013, backing up of 2013, February, mid-October, high volume. Okay, great. So I will come back to October in a second, but everything else sounds really good. So what are we looking for as kind of like this final confirmation, is the confirmation that should be giving us, a high level of confidence to follow up with this trade. It's probably going to be in a spot here after the major sign of strength, which basically tells us that the character now is to move the price to the upside and have small reactions, very, very small reactions. And this major sign of strength confirms the uptrend, and the backing up action confirms the change of character. So anything around this area where we could identify a potential C in a smaller trading range, that's number one. Where we see the breakout, that's number two. Where we see a smaller backing up action, that's number three. Where we see another breakout, that's number four. And it also presents a short-term weakness after this rally. So therefore, it acts as the final confirmation, especially on the breakout right here, of what's to follow. So I want you to think about this for a second. Why is this so important? Well, because usually students come and they say, well, I want to invest here in phase C. Could you teach me to invest here? And I usually say, yes, I can. But before you learn how to do this, can you please start identifying these spots to me? Where you have a very high level of confidence that there's going to be a continuation. Once you can deal with that, could you identify to me in the middle of the sign of strength rally a point of entry there? Or maybe a point of entry on the last point of support in phase C or even or D. And only after that, go for phase C. So it has to be sequential, the way how you educate yourself. Because the mind is always going to be egoic. Our minds are always going to be based on the fear and greed. And here we will be thinking about greed. We would want to go in to establish the position at the bottom. But in a way, it's not even greed. It's still fear-based behavior. Why? Well, because if we're thinking about establishing the position at the lows of phase C, we're basically saying, I'm fearful that the price will go low from here. I always want the price to go higher. So fear is an extremely strong emotion for us, humans. And a lot of the survival mechanisms are built around fear, and our trading, unfortunately, built around those surviving mechanisms. So fear is going to be very, very dominant. Now, there was one comment here, which I really liked from Adam. Adam said that the high probability place to open the position is going to be in mid-October, somewhere here, which is based, I believe, Adam said, high volume signature. So disregarding even the volume signature, which we will discuss in the second month, this is a correct place to think about the point of entry. This is not necessarily the highest probability place, and that's the only caveat that I would add to Adam's remark, but it's still one of the points of entry that we will be discussing in this course. It comes after phase C. It shows to us a short-term ability of the rally to come to the previous local resistance, and look how flat this trading range is, this reaction is. It doesn't come to the level of the support. It's all flat. And obviously, we could talk about the volume signature here, but maybe not for now. Not only that, on the relative strength ratio line, which basically shows the leadership of the stock relative to the market, we're seeing that the breakout produced also a breakout in the leadership, which is a confirming sign as well. And we will study that in the third month, when we'll talk about the relative and comparative performance. So all of the points of entries are going to be talked about, guys, so don't worry about that. All of the confirmations are going to be talked about. It's just a lot of material, and obviously I can't give it to you right away, so we'll see how it's going to unfold. So after the first rally into the major sign of strength, we're seeing a reaction, and hopefully, guys, you could see this. I'm going to put the color here, blue color. This is the reaction that we're seeing. So for the first time in this rally, since the lows in the potential phase C, we're seeing the reaction that is outperforming all of the reactions to the downside. We see how this reaction increases in distance. You don't see it here, but I'm quite positive that with that increase in distance, the down spread has increased as well. And we're seeing, maybe a slight increase of the supply here. It's actually not that pronounced. So it's more over the latest reaction. Actually, supply level is kind of the same as other reactions, which tells us what? Here is, kind of like a preview on phase A bias identification, phase A bias. So what would we be thinking about the bias in phase A? Well, because the supply is at the same level or somewhat low and doesn't produce, an extreme move to the downside, we don't actually go to even 1/2 of the move that we've done. We probably would be thinking that the bias is still going to be reaccumulation at this point. And that's the way how I'm going to teach you guys. Your first assumption about a reconsolidation or a stepping stone trading range is always going to be the bias that you've defined in the trading range itself, and the trend that we have had. So therefore, a bias to the upside, and therefore a reaccumulation. And then we would be seeking confirmations throughout the range. And either we're going to confirm that this is a reaccumulation, or we're going to reject this as an idea. So all of these elements here, just on the price alone, suggest that we're going to go into a trading range. By the way, now that I've talked about the bias, let me talk really quickly about the duration. This could be just a preview of what's ahead for those of you who's going to kind of graduate to more advanced level. Think about the increase of the supply. Is it a lot of supply or not a lot of supply that comes in on this change of character? Probably not, right? So increases, but not substantially. So what could we say about the level of the supply? The level of supply